following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and that music means it's time once again for Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I am joined today on the old Volatility Views program by a sickly but still struggling on Don Schlesinger from the Volatility Exchange. Don, welcome back to the program. Glad you could soldier on and make it for us.
Well, thank you, Mark. Listeners might remember that last week I was complaining somewhat of a little bit of a cough and a scratchy throat, and during the week or 10 days since we last met, it's kind of blossomed into a full-blown spring cold, so listeners will excuse a somewhat nasal or raspy voice, and I'll do the best I can.
That's such a departure from you, Don, from your usual voice. And listeners, we are also joined on the old program today by our volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, how are things over in the land of Option Pit?
Busy. I just got back from New York. I've been kind of running around. I'm watching the markets today. I'm kind of interested in what's going on, and yeah, it's kind of an exciting day. So, what's going on in the land of? And I got a book here for you with your name on it. So I gotta run into you sometime in the next couple of days.
You keep promising me this book. Of course, listeners, if you don't know, Mark, why don't you give your book a plug here, right on the top of the show, the book that just came out.
Sure, it's called...
Notice how you had to twist his arm there, Mark?
No,
that was hard.
I'll read to you a quote from somebody that made a really nice recommendation. It's called The Option Trader's Hedge Fund, a business framework for trading equity and index options by Dennis Chen and Mark Sebastian. And here's what a very, very strong source in the option universe wrote. From trade selection to execution, risk mitigation, and volatility analysis, everything you need to know is contained within these pages. Whether you are a newcomer to the options market or a seasoned options veteran, the insight and analysis contained in this book will provide you with the proper framework for your option trading. That's from Mark S. Longo, founder of the Option Insider Radio Network. And
personally, I don't trust that guy as far as I could throw him.
No,
you know, that guy,
I don't either.
Take Mark Sebastian to write that.
But yes, congratulations on the book, and I'm glad that it's faring well, and I'm looking forward to getting my final physical copy as opposed to the early proofs, which don't give the full work justice, if I do say so myself.
No, not at all. Not at all. I agree.
That's great,
wholeheartedly.
Congratulations.
Thank you very much. It was, here's what I'll say is that writing a book is not that fun, but it's kind of neat seeing your name on the end of a product.
Yes, it is.
So, and so far the reviews have been pretty good from readers, and that's what's most satisfying is it's an area that I don't feel like a lot of people have gotten into as much as, say, this is an option, this is this. Ours is more of kind of how do you build an approach as opposed to here's what a butterfly is or here's what a call option is. And I think there's a market for that.
Certainly seems that way, sir. All right. And with the gang assembled on this Monday morning as opposed to a Friday morning, we're recording a little bit late, listeners, so you'll apologize our tardiness, but the gang is finally assembled, and it's time to dive into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we look back over the week's worth, or in this case, the week and a day's worth, or week and half a day's worth, of volatility action. You know, the past week was an interesting one. I was joking on one of our other programs, the Option Block, where we've had some days where we were recording and we had some great movements, and then last week we had the good fortune to be recording two shows in a row, which I don't think this has ever happened before, and the probability of this is quite low. We recorded two shows last week where the S&P closed 0.0, unched completely and literally on the day. I've never seen that happen once, let alone it's always 0.01 or something like 0.1, something like that has a little bit of movement to it. But literally 2 days, both days we recorded last week for the Option Block, 0.0. So from a vol perspective, it was an intriguing one to watch. Of course, where there was some action actually and some trading action and some volatility, pun intended, were in the volatility products as opposed to the underlyings themselves. So I suppose we'll start there, as we are wont to do, into the land of S&P 500, a.k.a. the VIX. Mr. Seabass, in between your many book signings and your pleasure cruises to New York and back, what were you watching from a volatility perspective over the past week?
I mean, they, despite kind of risks and stuff, they took the VIX in pretty aggressively last week from the highs. It touched out near 28% on Monday, and then immediately sold off 25%. You know, if you look at kind of S&P realized volatility, even the current, 21 3/4 is overpriced. The stock, sans the last 10 days, has been a lot, well under 20%. 10-day vol is around 21%. So we are seeing at least some action in, in the S&Ps relative to normal. The one thing I'd point out is that 21 and 22% is actually a lot higher than people think. People think, well, that's just barely over the mean. Well, the one thing people have to understand is that the VIX has many more occurrences below 20 than it does above 20. But because of kind of boundaries and the ability for it to go endlessly higher and really be bottomed out at maybe 9.5%, that mean is more 20%. So, I think that the VIX, we may have seen the low in the VIX on Friday that we're going to see, because if we have Spanish election or Spanish bailouts and the S&Ps are down on the day, that does not bode well and could certainly point us toward, now we're going to have Ireland asking for a give back, and certainly Greece, and that's going to cause all kinds of problems.
It's interesting here because this situation, in some ways, is a bit analogous to the situation we found ourselves in last year, going into the big debt debate and the debt ceiling debate. And of course, back then, as you'll recall, and we touched on it on this show as well, everyone and their mother was fading the VIX to the downside because they thought whatever happened after that impasse was lifted, the volatility was going to come in. So everyone, of course, faded VIX to the downside. And then, of course, we all know what happened. The downgrade followed shortly thereafter, and the VIX was off to the races, and you had to roll for a long period of time in order for that downside to actually pay off. What's interesting about this is that everyone is watching that Greek vote coming up in about a week or so, and yet we're not seeing, at least not yet. I haven't seen any. Maybe Mark, maybe you're seeing something I haven't, but we haven't seen any of that playing off yet, where people are saying, well, regardless of what happens with Greece, the vol will probably come in just because it's the big impasse is over. People are obviously thinking maybe there's more vol to come, or maybe they got burned last time.
They're clearly thinking there's more vol to come. Otherwise, the market would be up and VIX would be in, I thought VIX could have been in 3 points today when we were up 15 handles last night. Folks, this is kind of an interesting thing. We've had a 20-point swing in the S&P 500 futures from last night's high to where we're currently trading. That's not something to laugh at. This is where that concept of overnight volatility. Clearly, the market is fearful of something, and it's got to be Greek. And Ireland's already asking for money back. So, and I don't blame him. I mean, it is a different situation. But if you're Ireland and you sit there and watch Spain handed essentially tagless bailout, and you're Ireland and they're just making you go through incredible austerity, and Greece as well. Even if it's something you deserve, you're not going to be super happy about it, right?
They want money to reopen all their pubs and perhaps start smoking in their pubs again over there. That's what they're angry for over there. I shouldn't joke. We have nanny states creeping in over here too. Can't even buy a large beverage in New York anymore. I'm sure you were very broken up about that, Mark, during your most recent trip.
Well, you can still buy a Mickey's Big Mouth. So I was okay.
You were all set. All your needs were covered. Well, Don, I know you're dragging over there, but you think you have the strength to muster a NASDAQ vol review for the past week, sir?
Yeah, sure. And the bottom line is that in terms of realized volatility, there was practically no movement at all. I think I recall saying that we might in fact continue this slight upward trend, but I'm not going to take any credit for a couple of hundredths of a decimal point, because both 1 month and 3 month realized volatility are practically at the exact same place as when we had our last show about 10 days ago. But what is interesting is a trend, and it's a very gently up or positive sloping line for both the 1 month and 3 month realized volatility, and yet it's come a long way. So if I go back on our charts to what looks like February 2nd, the 1 month or 21-day realized volatility on NASDAQ bottomed out at 9.61. I think you can remember our discussing about how extremely low that was at the time. And we now are sitting at 19.34, and we have actually, 19.59 is the last tick. We've actually more than doubled since that February reading. The 3 month is similar. The low point came about the 3rd of April, and it was 10.9. And we currently sit right now at 17.22. So it's been gradual, but the trend is surely upward. And I would just further point out that both of those readings today, 1959 and 1722 for the 3 month, are still somewhat below historical averages. So long-term averages for 1 month NASDAQ volatility, about 21.75, and slightly over 22 for the 3 month version. So we're still a little bit low by historical measures.
All right. Thank you for that, Don. And that's going to do it for our volatility review. And now we're going to dive into a quick volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that funky music means it's time once again for the Volatility Viewpoint. Longtime listeners know that this is the portion of the show where typically Don and I and Mark like to grab a guest and sit down and pick their brains about volatility and volatility action and what they have going on in the world of options and options volatility. And today's guest is actually a name a lot of you are familiar with because he's been on this show many times since its launch. He is, of course, our usual volatility pit reporter, but he's jumping into the guest seat today. None other than good old Mark Sebastian from optionpit.com. Mr. Sebastian.
Hey!
Yay!
Wow, I feel so honored.
Those trumpets are blaring. That is for you, sir.
I feel honored. I feel like I feel super special right now. This is awesome.
Well, now that you are an author extraordinaire, it seemed fitting to put you in the guest seat. Long-time listeners will actually remember that Mark was actually, I believe, our first guest way back on episode 2 of Volatility Views. Is that correct, Mr. Sebastian?
I believe so. I believe I was.
And and we just haven't been able to get rid of him since, listeners. He's stuck around ever since.
I made such an impression.
You did indeed make an impression. But Mark, in all seriousness, you have obviously been on with us for quite a while. You've interviewed a lot of our guests, but there are a lot of other things you have going on over there at Option Pit that a lot of our listeners may not be familiar with. So maybe we'll start there at its most basic. I'm not sure if you've ever taken the time to actually sit back and say, hey, this is what Option Pit is and what you guys do. So why don't you give our listeners that 10,000 foot overview, if you will?
Well, I'm an ex-market maker on the Amex and the SIBO, and when I left the floor in early '09, I kind of got indoctrinated into, I worked for another educator, kind of saw some of what he was doing, and realized that, and then looked across kind of the entire atmosphere of the option education business, and basically felt like everybody was essentially assuming that everybody in the retail public is stupid, and that the path of least resistance was the best path, not the path of the most knowledge. And so a buddy of mine from high school and I set up Option Pit as the first option education business that is founded on the principles that we teach market makers fresh out of college. And that's true, strong, fundamental understanding of how options function. And then we can talk about trading. It was one of the things that I really thought was interesting is what most people in the education business want to teach you is here's a strategy, and then you'll learn the rest as you go. What I want to do is say here's how options function. Now figure out a strategy to go with that. And so we developed Option Pit as an education service to take the new trader that wants to learn to understand options all the way through to what is essentially the highest you can achieve in the retail public. And then on top of that, offer professional consulting services to already professional traders. So on one hand, we have a group of retail traders that we're teaching the right way to trade. On the other hand, we have a group of professional traders that we're doing consulting work with. And by that I mean we punch holes in trading ideas. We help them hone trading ideas. We'll help build positions based on, position ideas based on how somebody feels about the market, and so on. So we really have a full approach to trading. I mean, our clients basically go from guys trading $1,500 all the way up to $15 billion. So it's a really wide-ranging, and we cast a wide net because we feel like basically everybody else in the business is teaching junk sans a couple of very specific people. So I think that's us in a nutshell.
It's interesting because you and I both kind of learned by being thrust into the fire, as it were, down on the trading floor. And I've always said, and you've always said that is indeed the best way to learn, if it's possible, is to go through that experience. But of course, that's not for everyone. Everyone can't go down and get a badge and be essentially apprenticed by a market-making firm and learn the risk management and the options performance game by seeing these things unfold in front of them in real time. It's kind of like learning a foreign language by just moving to, let's say, Italy, if you want to learn Italian, and immersing yourself. Not everyone can take that approach. And of course, these days, with the floor is essentially dwindling and most of those opportunities vanishing everywhere you look, it is becoming more and more difficult for someone to follow that approach. So it is interesting that you guys decided to take that approach and replicate it for a broader audience who may want that same level of indoctrination, as it were, but can't or don't want to go through the process that you and I undertook.
I mean, think about this. You and I don't know everything about options, but we've got a really good education. And this gets to my point. And Don, too. Don's incredible. You and I, we don't know everything, but if someone starts explaining to us a strategy and what they're doing, you can
reasonably intuit it, yes.
Yeah, we can. It comes to us intuitively exactly what they're kind of talking about. And that is why if you really learn how options and futures and everything really function, how volatility works, the ins and outs of options, the strategy is not as difficult. And I think Don would probably attest to that, as I know that he's of the same ilk.
Yeah, as a matter of fact, it's interesting that you mention that, because when I've been, involved in doing our options seminars and derivatives training, you get to the point of the strategies themselves, and you're going to cover all of the standard textbook ones. I always preface it by saying, I could stand here and say to you, this is a bull spread and that's a bear spread, and here's a butterfly and a calendar spread, and this is what a straddle looks like. But after a while, your head would be spinning, and none of it would really mean anything. What you really need to do is to understand a scenario or some sort of market viewpoint that you have, both for directional movement, for volatility, for the time frame. And then if you have an understanding of what these strategies are, you then try to match the particular position or strategy to what your outlook is. And by doing it in that manner, you get a much better feel for why people do certain things and what these different strategies' roles are in the grand scheme of investing.
So much of what passes for options education today is really, exactly what you just said, Don, about they show you a strategy, and they say, here you go, here's the P&L graph, here's how it performs at expiration, and that's kind of about it. And there's very little in the actual day-to-day of what happens in between those 2 points, and how, of course, options perform as a result of that. That really is the nitty-gritty of what makes or breaks a trade, and yet so many people are just, like you said, here's the strategy, here's what it looks like at expiration, go forth and prosper, my son.
Yeah, and it's as if to think, people wake up and say, oh, today's Tuesday, let me do a butterfly. Oh, on Thursdays I do calendar spreads.
It's 30 days to expiration. I should buy a calendar. It's ridiculous.
It's just not the way it's supposed to be.
No, and down to that point, if you ask a real pro how often he looks at his risk graphs, I looked at my risk in the morning, and if I made a substantial change in the position, I might pull up what my risk in the next couple of days and in a week from now looked like on microhedge. But Mark, Don, did you ever really take the time until 2 or 3 days prior to expiration to look at what your expiration position looked like? And did you ever actually look at an expiration graph? I almost never did.
No, I mean, the only time you really started messing with that was, you're right, like the week of expiration, because your theta and gamma went insane, and so you had to try to find some way to account for that. Of course, now with weeklies and perhaps dailies on the horizon, expiration takes on a little bit different meaning. But still, you're right. It wasn't. You didn't sit down and say, "Here's my P&L graph at expiration." You really just looked at your swings. Here's plus 10% in the underlying, down 10%, and here's my extreme risk moves. How am I hedged? How am I prepared for those? That's what really matters.
And the reason why that worked is because you looked at your position and you knew what you had on. You could do the synthetics analysis and you could look through everything and figure out how everything worked. And that's why everybody hates me when I get up in front of a crowd, because I come off as a little doom and gloomish and maybe a little arrogant, because I sit there and tell people that...
You never, sir. Heresy. How could you say such a thing?
And it's horrible of me, but A, they're likely to fail, and B, I'm sorry, but there's no shortcut. Now, the good news for most people say, well, if I'm likely to fail, or I'm not going to make a lot of money trading options, Why would I bother to learn this? Well, guess what? You'll still probably outperform your financial advisor, or just put your money in spiders or something like that. But it's really important that people learn those fundamentals. I'm sorry, it stinks, but if you would be shocked the number of people that actively trade options that will ask me, I don't get why how SPX expires on this day or doesn't on this day, and you're like, and it's shocking. So
there's a lot of those fun little product nuances that people just tend to
they say,
overlook.
I don't need to know that.
I don't need to know.
Right.
What is this roll stuff? I don't need to know anything about that.
Exactly.
Well, there is a lot of interesting stuff going on out there in the land of education. I think we could probably spend a lot of time discussing the problems overall with options education in general. It is in many ways, and it's kind of unfortunate, but for a lot of retail customers out there, it is indeed a minefield that you have to kind of negotiate. If you pick the wrong educational company or the wrong mentor, it really could be a massive sucking sound on your wallet and on your trading account.
Yeah, I mean, that's been the biggest thing, is that most people, and this is going to sound very awful, and it's going to make me sound, unfortunately, and this is what makes my business so hard, most people that are in the education business do not have the most scruples. And so it makes those of us that are honest to people, it makes our life difficult, because we not only have to sell ourselves, but we have to sell people the truth, which normally you should not have to do. There's no Consumer Reports out there for option education businesses, unfortunately.
Yeah, there should be. And that's really an approach we've tried to take from the beginning with the Options Insider, is to try to only partner ourselves with legitimate, reputable brands in the option space, people who actually know what they're doing, people who have backgrounds that are analogous to mine or something similar, where they actually have practical options experience so they can provide some insight for our audience. But unfortunately, that's not an approach that most people in the option space take. And so we've taken the time to build a contributor network. We've taken the time to build up relationships with the quality names and the quality products and the quality sponsors and contributors in this space to really provide some sort of reputable alternative. And you guys have done something similar with your approach at Option Pit, but that's so few and far between, and that's made both of our jobs difficult, because we are just inundated, I'm sure you are like I am, with just people with complaints and comments and about, I got scammed by this guy. And everyone's seen the late night infomercials make money in any market condition using options. All the scams and the shows that are out there, the various trade shows. You have the guys hawking strategies in every booth you could think of. It's a cesspool out there. So listeners really need, and readers need, a guide in many ways, if they can, to really navigate that minefield. So we've tried to we've endeavored in every way possible to help people do that, and that's one of the reasons why we like working with you guys over at Option Pit, because as crazy as you guys are, we know you're not. You guys know your stuff, and you're not going to come in and show someone a picture of a Ferrari and say, you could be driving this next week if you just sell straddles.
Yes, agreed. That's exactly right.
That is perhaps the highest compliment I can pay to you, sir.
That is the nicest thing anybody's ever said to me. Thank you so much. Yeah, you might be a jerk, but at least you're an honest jerk.
There we go. Perfect. Well said, sir. I could not have said it better myself.
Thank you.
But I know you have a lot of interesting things coming up at Option Pit. We did just touch on the book. Of course, listeners can find that on Amazon. Just search for Mark Sebastian if you can't remember the title, and you'll find it on there. And of course, you have all your various. You have a big extravaganza coming up sometime soon, I do believe, right, at Option Pit?
Yeah, well, we've just got some of our current students coming in on Thursday and Friday. We're going to go to a Cubs game, and we're going to hang out at Know Your Options and in their office and do some just live trading, kind of hanging out and trading, talking shop. There's nothing like just being in a room where you can actually look at people and you can talk the business. It changes everything. So
I think you and I, one of these days, because we did touch on it and it is right now, and it is such an interesting topic, maybe we could sit down with some other quality mentors and educators from the option space and really kind of run down the problems with options education these days.
Absolutely.
And perhaps some
a
potential
nice symposium.
Yes, some potential solutions for that, because it is such a minefield. And even 5 years after we launched our site, there's still so many people out there trying to say, hey, help us navigate this horribly, horribly dangerous environment. So that might be an interesting topic for a show down the road. But right now, Mark, we're going to wrap up this, your second actual appearance on the Vol Viewpoint in the old hot seat. But thank you for joining us today. But you're not. Don't worry, listeners.
Fun.
Don't worry, listeners. Mark isn't going away, because now we're going to dive right into our listener mailbag.
Listener mail. Listener mail. Listeners, write in.
Mailed in.
Mailbox.
All right, and welcome to the old mailbag. And this is the portion of the show where you guys, the listener, get a chance to chime in. And first up in the old mailbag, we have a Facebook question from Chris Monty, and he writes, the SIBO is in the process of changing the way they list weekly options. How do you think this change will impact weekly option volatility, as well as the way these options trade and the way they perform? Thanks again, and I love the show. You guys make my commute to work a little more bearable. Well, Chris, we're glad we could make your day to day a little more fun. Hopefully that your job isn't too bad where you need to listen to us to unwind or enjoy it. But thank you for those kind words. And you're right, there is an interesting change going on in the world of weeklies right now. We've talked a few times on other programs on the Options Insider Radio Network and touched on it a little bit here on VolViews, just the nature of weeklies in the equity options world versus weeklies in the futures options realm. And equity options weeklies have always been listed kind of like in this free-for-all manner, where every Thursday they list the weeklies for the following week. And of course, as soon as that bell rings, everyone is racing to hit the bids, and that premium decays to zero over the course of the coming week. And 90% of the liquidity in these products is geared towards selling that premium. Whereas on the futures side of the fence, they've adopted a much more nuanced rollout, where they've actually decided in their infinite wisdom to list the full month's worth of weeklies at once. And what that allows you to do is have a lot more nuanced approach to trading weeklies. You don't have to just race in and hit the bid. You can maybe sell the front month against buying the third month, or vice versa, and do a lot of interesting things, because you can actually look at that full month's worth of options at a time. And that really seems to have changed the way those products trade on the futures option side, where they are essentially a lot more buyers, actually people coming in and actually using the product. And Don, I know that's heresy to you, Don, but people actually coming in and using the product the way they were intended, which is to hedge short-term, very near-term risk. And so it opens up that product to that type of trading. So it will be interesting to see if the SIBO and other exchanges following suit by changing the way they list weeklies will change the way these products are traded on the equity option side. My guess is yes, perhaps not to the degree that the futures option side is, where it's about 50% of the liquidity is actually buying in the final couple of days. I don't think we'll see that, but perhaps we'll see a drop from 99.99% selling on the opening bid to something a little bit more nuanced. And Mark, I know you guys over there at Option Pit really have been diving into the weekly fray quite a bit of late, and you have quite a few webinars. So you're
we've done a 3-part series. We've got a new webinar coming up on Wednesday on being long weekly premium.
So what's your take on all of this then? Because someone who's
I think it's incredible. What it's essentially going to do is make the concept of the front month serial month for the market makers almost go away. You know, the difference between the regular July contract now and all these new weeklies is that the July contract has been around for an extra 30 days. That's about it. And so you're going to see an incredible surge in volume in the weekly contracts, because institutions will finally be able to use them in a logical manner. One of the complaints about the weeklies is that with an 8-day period, you get this weird, crazy, herky-jerky decay. You know, it decays really fast, then it over-decays, so it pops back up. Then it decays really fast, then it pops back up. If you're an institution, you can't deal with something like that. You need something that makes sense to you. having options that are 30 days old but expire every week will allow for, generally speaking, a smooth decay. And that smooth decay should allow institutional paper to begin flowing into the weeklies. I think you'll see a huge surge in weekly volume. It will be probably 80% stolen from the regular serial months, but I think it'll actually produce 20 to 25% of that volume will be brand new paper, as institutions are really able to zone into their hedge. That's my general thought.
This is something that's going to impact our ultimate marketing decision as well, in terms of bringing out the 1 month or 1 vol realized volatility contracts, because the original premise was to have listed these serially and have them expire corresponding to the monthly options expirations for people who might use a vol contract to hedge an options position or volatility exposure. But with the advent of these serial weeklies, 4 to the month, it really does become rather clear to us that if people are going to hold positions in each one of these options 4 times a month, then in fact it might make a lot of good sense to have matching vol contracts that would correspond to those weekly expirations. So when all the dust settles and the smoke clears, we may very well have 52 monthlies in terms of the actual 1 vols, because they very well might be expiring every week to match the options expirations.
Yes, it certainly changes the notion of the 1 vol and what that actually means going forward. It becomes a little bit more of a fluid concept where you have essentially new contracts coming in every week that we've been tracking for a month, and people wanting to have the full vol spectrum on each of those as well. So yeah, in short, Chris, this is going to change a lot of things, and it's hopefully going to be a change for the better as we get a much more nuanced strike selection, much more manageable and sensible decay, and many more things that I think are very interesting. And this is something I've been kind of pounding on the table on and saying should be done for quite a while, that they should really replicate the way these things are being listed on the futures options side. And I'm glad that the SIBO and others are finally starting to wake up to the need to do this, because the way the weeklies have been traded so far has kind of been just, on the equity option side at least, far too haphazard. All right, next up on the old listener mail segment, we have an email question from Theodore Johnson out in Boise, Idaho. I've never been out to Boise, but I've heard many people have actually told me that, especially this time of year, it is quite lovely. So maybe I'll have to swing out there one of these days and pay Ted, or Theodore, I should say. Shouldn't assume he goes by Ted. Theodore a visit in lovely Boise. And he writes, in a time spread, which risk/opportunity should I really focus on, gamma or vega? It seems like trading time spreads is essentially finding a proper balance between these two. And Theodore, you've made a very astute observation with your analysis here in the email, because that is in many ways the ongoing balance when you're constructing these calendars or these time spreads. You have to weigh the gamma risk slash gamma opportunity versus vol. And for most of us here, having come from the professional trading side, we tend to view these trades as vol trades, and all of our trades for the most part as vol trades. So you really want to give yourself, in most of these trades, the opportunity for your vol position and your vol viewpoint, pun intended, to pay off. And that means to either suffer through the long gamma and be able to offset that long gamma with hedges to make your long gamma go away, or in the case of a long time spread short gamma position, being able to weather that storm of short gamma and being able to survive making small hedges, or being able to offset that short gamma risk long enough for the volatility viewpoint and the substantial profits to be made on the actual vega side of the equation. So I think most of us here, hence the name of the show, tend to lean towards the vega side of the equation. But in many senses, they are.
I think it's 6 of one, half a dozen the other. You're basically on a short and long time spread, you're making a bet on realized versus implied, right? If you sell a time spread, you're long realized, short implied, which means you think that realized is going to outpace implied. And if you're long a time spread, you're short realized and long implied, which means you think that realized is going to underperform implied. And that's really how I think about time spreads when I trade them. Does that make sense to you, Don?
Yeah, what's very frustrating, if you will, in the management of a calendar spread or a time spread for listeners who may, not be familiar with this type of a position, you're basically trading two different maturities of expirations, a nearer term and a deferred or a farther term. And the problem, as we've been discussing, is let's say you buy the calendar spread, which means you buy the deferred month and you sell the near term. And let's say the underlying's at 100 and you do it with at the money options, calls, puts, whatever. The problem that you create is that when you look at your risk profile, it does look as if you have that short gamma type position where you would profit from an unchanged market, or a market that isn't going to have violent swings or a big trading range. Almost looks a little bit like the profile of a short straddle, that kind of an upside down V. But at the same time, the calendar spread has a characteristic of volatility exposure that is diametrically opposed to the short straddle. When you sell a straddle, you want volatility to go down, the implied volatility. But because you're long the deferred option and short the near, there's a greater effect on the price of the longer dated option when volatility goes up than is the case on the shorter. So calendar spreads have this kind of schizophrenic identity. When you buy one, for example, that your short gamma looks a little bit like a short straddle, but you actually want implied volatility to go up. And that's almost like you're rooting against yourself. You want to try to park this thing unchanged, not have too much movement in the market, because violent movement will probably hurt you. But at the same time, you're saying, let the market be calm, but it would also be nice if implied volatility went up at the same time, which doesn't happen a lot of the time. So that's the challenge of a calendar spread.
I'm trying to remember. I don't have it off the top of my head. I was trying to pull it up while you were talking, Don. But we did obviously discuss this very early in the run of Volatility Views. We had a whole show, or perhaps a series of shows, discussing this exact trade-off of the almost antithetical situation you find yourself in, or perhaps not the antithetical, but the paradoxical situation you find yourself in, where rooting for a movement yet not wanting movement. And listeners will have to surf on over to theoptionsinsider.com, or actually go over to volx.us, where you have that great list of the episodes from beginning till now, or search for Volatility Views in iTunes. You can find those early episodes where we did indeed discuss this topic in great length. So great question there, Theodore from Boise, and it is an interesting one, and you're right, it is the perpetual trade-off, whether you want to see it as realized versus implied, or as Vega versus Gamma, or perhaps a combination of the two. There always is. Trading calendars is balancing those trade-offs correctly. So surf on over to those early episodes, and we get into that conversation in much more detail. And I think we'll finish out the old mailbag today with an interesting question, certainly one that left me scratching my chins, not one I've encountered on our shows before. So I'm curious to see what you guys have to say about this one as well. It's an email question coming in from Charles Stevens, writing out of Frankfurt, Germany. And he writes, I'm an expat American currently living and trading in Germany. As an old-school options trader, I've always considered myself first and foremost a volatility trader, and Charles, I think pretty much everyone here on the panel would pretty much agree with that perception. He goes on to say, I mostly view my positions as vol positions, and I'm always looking for interesting new products like vol contracts, VIX, etc. that will provide me with a new way to hedge/trade volatility. When I moved to Frankfurt, I was very surprised to find that most of my European colleagues don't share that perspective. They aren't up on the latest vol products/research, and they don't tend to view themselves as vol traders. I found this baffling, so I thought I would write to the authority on volatility to see if I am completely nuts or if this is a well-documented situation. Is vol trading and the interest in vol products primarily a localized American phenomenon, or am I just hanging out with the wrong crowd out here in Germany? Well, that's an interesting question there, Charles. I've never traded in Frankfurt myself. I know a lot of friends who went out there do trade options out there, particularly in the dot-com boom period of the late 90s into the early 2000s before everything imploded. That was a high time for a lot of people to head out there to Frankfurt as an options mecca. But this is the first time I've ever heard anyone actually say this, that they haven't seen Frankfurt or just European traders in general as interested, perhaps, in volatility. And certainly maybe some of that could be traced to the notion that VIX kind of did explode here. It is an American product. It is listed on American products essentially, and the explosion that became VIX really took everyone by surprise, including the people who created it. That no one expected VIX or the volatility world to really be such a popular series of products. So I think some of that might have something to do with what you're saying, in that the groundswell of interest in this stuff certainly has sprung up out of the U.S. and on trading U.S. products. But of course, there is still that OTC world, which a lot of the Europeans tend to trade in when they look at vol. There aren't as many interesting, or should I say, perhaps heavily traded volatility products that are offered in Europe. And people have tried to replicate what's been going on over here overseas with various degrees of success. We've seen India VIXs, we've seen other VIXs on other products and other international products with a minimum amount of success. So I think part of it, if this is indeed the case, I'm not certainly saying that it is, but if you're right, Charles, I think a lot of it perhaps could be attributed to that. This is very much a homegrown phenomenon that has spread up over here, and perhaps maybe as more expats start to make their way out to Frankfurt and other international trading hubs, perhaps that viewpoint will carry it with them. What do you guys think about Charles's supposition here? Do you agree with him? Disagree?
I think one of the interesting things about over there is that the market in Europe is so much more fragmented than it is in the United States. And so while he may not be seeing on the listed side, my understanding is that there is a massive variance market done over the counter in Europe, and that it is a huge business in the European markets. Don, stop me if I'm telling tales outside of school.
No, I think that what we have found in our travels and in trying to present the volatility exchange and vol contracts, not only in Europe but in Southeast Asia and around the world, is that there is considerable interest in volatility and volatility trading. But as Mark Longo pointed out, the proliferation of homegrown products and the types that we see in ETFs and VIX products here kind of skews it in favor of the trading in the United States for listed products. But when you do go abroad, you do find that there's a great deal of volatility trading going on, vol swaps, variance swaps, options trading. But as you mentioned, a lot of that is over the counter and off exchange. If you're going to trade kind of options positions that have sensitivity to volatility, which is practically all of them, you need a developed listed options market, and that just isn't always the case for many of the countries. So you need the liquidity and the exchange traded interest in options in order to generate that interest that would follow up for volatility trading. That said, we tend to see, at least we did in France, tremendous interest on the part of the French for volatility. And if you look at a lot of the scholarly papers and academic studies coming out on volatility, you'll see a tremendous amount of French names and people with French and Belgian backgrounds. They tend to be extremely knowledgeable and interested about volatility trading.
That's true. There is a high penetration of French customers in the SPX. Back when I was down there, a lot of the institutional customers, for whatever reason, it was always the joke, oh, here comes another French customer on the other end of the phone. So perhaps a lot of that interest would delve into the OTC vol as well.
think about this. I mean, all of Europe is about the size of the United States in terms of size of the economy. And yet, how many different exchanges are there in Europe? Like 13 or something ridiculous? Trading different products, right? We have one kind of centralized index for the United States. And you can call the Euro Stoxx 50, but that doesn't really do it the same way.
Yeah, that's not exactly analogous.
No, I mean, you can legitimately hedge the United States pretty well using SPX. There's no product like that, and thus VIX for volatility. There's no real index that does that for Europe, does it well.
So there you go, Charles. We have a lot of fragmentation and a lot of stuff going on OTC, which perhaps is also why you're not seeing it. And also it's like we said here, just a culmination of many different things leading to that perception that what you're seeing over there in Frankfurt. But I will say this: there's one thing that your question and all the questions we've received today here prove that we just have the best listeners here on Volatility Viewers, because our questions run the gamut from all kinds of things that you might expect under the volatility rubric. So thank you for that, Charles, and thank you to all of you who wrote in to join us today on the old mailbag. If we didn't get to you, hopefully we'll have a chance to get to you soon, but we're going to have to close out the mailbag for this week and dive right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, I'm always never sure what to make of what I'm supposed to feel after listening to that theme. It's a little bit haunting, a little bit perhaps foreboding, perhaps implies a very dour prediction for the future. I don't know, or very dire prediction for the future going forward. But yes, this is, of course, the crystal ball segment. This is where we prognosticate wildly about the future of vol and all things volatility related. And Don, since you're hanging on by a thread, sir, why don't I let you go first with the NASDAQ crystal ball?
Well, I'm going to not change significantly from the way I felt last week. I mentioned those upward sloping charts at the top of the program, and still with the market reacting somewhat negatively today, despite the announcement of the Spain bailout, there seems to be still a good deal of doubt and a good deal of unrest as the European situation continues. So if I do have to go out on a limb, I'm going to look for still nothing major, nothing dramatic, but slight increases in volatility. I will point out something that I find interesting. I was going to mention it to Mark Sebastian as the basis for a possible trade, and that's when you look at the Volatility Lab, the Volatility Institute, forward-looking predictions that Robert Engel furnishes for us on our website, and you look at predictions for the S&P going out 1 month, 3 months, and 12 months. You find that all the numbers are practically identical, which is very interesting. It's predicting future realized volatility of the S&P, and in all cases, despite the time frame, the numbers are about 17.6 or so. When you look at NASDAQ, it's a very different situation, where the short-term prediction is for about 21.7, 3 month almost 23, and 1 year, 25.5. So it's as if there's almost the possibility for a longer-term spread there, where you might want to buy longer-term NASDAQ volatility and sell that same longer-term S&P volatility, because their studies are showing that that spread ought to widen. And the part that's interesting is when you look at recent volatility, 1 month or 3 months, NASDAQ is about 3 points higher. Whether it's 3 month volatility or 1 month realized volatility, NASDAQ is about 3 points higher than the S&P. And yet when you look at historical averages, for example, long-term 3 month NASDAQ volatility, it's almost 5 or 6 points higher on average than S&P volatility. So it's interesting to look at that as the potential for some sort of a trade where, whether through options or however, you would look at the potential for a widening of NASDAQ volatility with respect to S&P.
You know, Don, that's an interesting point you brought up. I was actually taking a different kind of trade in that with the Apple conference, one of the things I think is really holding up the NASDAQ is Apple. So what I was thinking is whereas S&P really only has, it's kind of, NASDAQ has two things fighting. It's got the bull market in tech versus the balance of the market fighting it. And the S&P does not have that same kind of exposure to what's really pushing the market, any type of the market higher. So I'm almost inclined to take the other side of your trade. So in that I think that where the risk in the market is all centrally located in the S&P. I mean, what's the biggest bank in the NASDAQ? Northern Trust? Maybe. And whereas the S&P, the FX, XLF is a huge portion of the S&P 500. So I think that's where we could see, if not, well, the fact that where we could see NASDAQ vol not move in the same way, it may not sell off in the same way, simply because it has Apples and Amazons, and it looks like even Facebook's done dying.
One of the things that is important to realize when all these Garch predictions are done, they do have to go back pretty far in time, and they have to use historical data, which understandably can be from periods where the composition of the index was appreciably different than it is today. And so with the dramatic importance, ever increasing importance of Apple in the NASDAQ index, which may not have been the case for some of the earlier periods on which the Garch predictions are predicated, that in fact could weigh upon the accuracy of such predictions. So listeners, you got to mark it down. It may take a year or so to resolve the question, but let's see how the volatilities react over the course of a long
term. You are 100% right. Near term, I think that trade goes against you more.
Well, Mr. Sebastian, I think you kind of tipped your hand earlier in the vol review about what you think is coming forward for S&P volatility. But why don't you give our listeners a quick recap here before we close out for this episode?
Well, I think we're in what I call a 2 a.m. at the bar situation.
You love your 2 a.m. at the bar analogy.
It's a great analogy. It's true. You don't have to go home, but you can't stay here. All right? So, I think that S&P's Euro, there's going to be a breakout in one direction or another. Something has to line up. Now, Treasuries, I think those are about to get smoked as soon as there's any resolution one way or the other. But S&P's, the Euro trade, NASDAQ, all of them, we're either going to be trading 1,200 or back at 1,450 in the next 30 days, I think. So that's kind of what I'm seeing.
So the S&P 500 is in your analogy drunk and looking for somewhere to go.
Mm-hmm.
I like it.
Exactly.
Probably actually is somewhat accurate given all the movement we've seen or lack thereof of late. All right. Thank you for that, Mr. Sebastian, and of course, Don. And that's going to close out our Crystal Ball segment. That's also going to do it for this episode of Volatility Views. And before we go, we like to give our listeners a quick catch up on what's coming up over there at volex.us as well as Option Pit. Mark, I think we pretty much covered everything going on at Option Pit. Anything else you neglected to mention?
Yeah, you know what? There's one little thing. If you buy the book, The Option Trader's Hedge Fund, it actually comes with a free month subscription to Option Pit Live, our subscription service, which we charge $125 for. So, the book's $30. So there's an arb there.
I see how you're gaming the Amazon rankings now. Very clever of you, sir.
Mm-hmm.
And Don, what is coming up over in the land of volex.us?
Well, the website continues to grow with new articles and charts and graphs and information that we're providing. We've had recent talks with a few of the options exchanges as they tell us what they'd like us to be able to do in the dissemination of information during the day of real-time volatility indices. So we'll probably have a little bit more to announce in that regard in the coming weeks, but everything is in motion, and we look forward to further discussions as we get nearer to bringing out our next contracts.
All right. Thank you for that, Don. And that is going to do it for this episode of Volatility Views. If you want to learn more about any of the topics we discussed on this show or want to listen to any of the earlier episodes that we referenced during this program, by all means, surf on over to theoptionsinsider.com. You can find all of that information there. You can also find it in iTunes. Just search for Options Insider Radio or Volatility Views. You can also find it over at volex.us, where those guys have a great list of all of the recent episodes. But before we go, we all here on the Volatility Views panel want to thank all of you out there for downloading and streaming and subscribing to this program and for providing us such great questions like the ones we had today. By all means, keep them coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.